Hello guys, hope you're doing well. This video will be focusing on investor ratios, the last category of financial ratios. In the previous sessions and videos, we had discussed uh, the previous four categories of financial ratios. So let's start with investor ratios. Earning per share (EPS). EPS is normally viewed as a key measure of an entity's financial performance. It measures the profit earned for each equity share of the entity. EPS is equals to net profit attributable to ordinary shareholders upon weighted average number of shares in issue. Let's move on towards another price earning P/E ratio. The price earning ratio measures how expensive or cheap a share is in relation to its annual earnings. A P/E ratio of 10, for example, means that the investors are prepared to pay a price for the share equal to 10 years of earnings at the level of EPS in the previous year. A high P/E ratio is usually a sign of confidence in an entity because it suggests that its earnings are expected to grow in future years. A low price-earning ratio usually means that an entity's future prospects for EPS growth are expected to be poor, so that investors do not put a high value on the shares. Mathematically, P/E ratio is equal to market value of a share upon earning per share. Now let's move on towards the next ratio, dividend yield ratio. The dividend yield ratio measures the dividend paid by an entity in relation to its price. The dividend yield ratio is equal to dividend per share upon current market price per share into 100. This is a measure of a return that the shareholder can obtain, that is, the dividend received, in relation to the current value of the investment in the shares, actually the price of the shares. A high dividend yield might seem attractive to investors, but in practice, companies with a high dividend yield might have a relatively low share price. There are two things to note here. Dividend yield reflects the dividend policy of the entity, not its actual performance. Management decides on the amount of the dividend, and this may not only depend on earnings, but on the amount that must be retained for future investment in EPS growth. The ratio is based on the most recent dividend, but the current share price may move up and down in response to the market's expectations about future dividends. This may lead to distortion in this ratio. Now let's move on towards the next ratio, dividend cover ratio. The dividend cover ratio measures the number of times that an entity's dividends are covered by profits. That is, how many times an entity could actually pay the current level of dividend from its available profits. Mathematically, dividend cover ratio is equal to earning per share upon dividend per share. A low dividend cover, for example less than 2, suggests that dividends may be cut if there is a fall in profits. So guys, this ends our discussion related to financial ratios. Hope you have had a better understanding of the financial ratios, but still, if you need any clarification regarding any of the ratios that we have discussed today and even in the previous sessions, you can actually comment. Please subscribe to our channel, like this channel, and share this thing. It's just uh, a service to the students and general public. Thank you. Okay, bye.